In this week's update, markets recover, but there are key aspects that must be watched. US credit rating downgraded. Will this impact markets? And gold drops on a move away from safe havens. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented in this video is of a general nature only. Another fascinating week, of course, never a dull moment with Trump in the White House, and it would now appear that trade negotiations with China have eased. So the big general triggers for the week affecting the whole market is obviously the big one, which really caused a significant jump on Monday, was de-escalation in the US-China trade situation, which was probably always going to happen, but Trump is just so unpredictable that it was hard to know how it would play out, what it would look like. But it certainly appears to be heading back in the right, sensible direction. At least that's what markets are voting on at the moment anyway. There was also a new US-UK trade agreement, so that helps, and I suspect that we'll see more of those tumbling through in coming months. There was also some very good inflation data in America, with both the PPI and the CPI numbers coming in lower than expected. So the annual inflation rate came in at 2.3%, which is the slowest in more than 4 years. So that's the good news, and that obviously opens the door to the Fed being able to cut rates. Specifically, if you look at semiconductors, there's a US-Saudi/UAE deals that are going to see very significant expansion into that region. So that's going to be very positive for the semiconductor sector. And that is always, as I say, whenever I discuss semiconductors, it's a very important sector for general market sentiment. When semiconductors are doing well, then generally the market is doing well, or it's certainly the aggressive part of the market that I'm most interested in. So they're the triggers for the week. Now, there's also a credit rating downgrade. Now, is this a big deal or not? I'm not sure, to be honest, because this has been bubbling away for 15 years or more, and markets just seem to ignore it. It really should be, logically, it should be a big issue, but markets just ignore it. But I just wonder whether this time it's going to become more of an issue. So that is certainly one to be watched. And I noticed that the US stock futures did shift down quite suddenly after the market closed on Friday. So it'll be very interesting to see how the market responds to that next week. I think the odds are more weighted towards the market not being terribly upset about it. Should be. It's a huge deal. But this is a brave new world of finance, so we'll have to wait and see. So specifically what happened is Moody's, which is one of the three major rating agencies, downgraded US debt from AAA to a level lower, a small A1. And that really follows other rating agencies, Fitch, etc., previously downgraded US debt, and the market had ignored it. So we don't know whether there'll be a different reaction this time. But the White House fired back, of course, and said, well, Moody's is pretty much incompetent, so why would you bother listening to them? The issue with the downgrading of US credit rating is it brings into doubt the US's ability to repay debt, their failure to reverse their ballooning debt situation, which is, I think it was around about 100% of GDP last year or the year before, and now it's expected to be something like 134% by 2035. So it's just really getting out of hand. And of course, with that goes rising interest costs. So as I said earlier, it should be a big deal, but markets just seem to brush it off and move on. So it's possible, in fact, it's probably likely that the US government is going to face higher borrowing costs in the future. Now, how that manifests itself as far as the stock market is concerned, we'll just have to wait and see. Now, every week I talk about the ease with which you can lose money in the stock market and the need for being very well organised and be getting very good broad-based advice to become a good, successful investor. And so I just need to point that out again because it's just such an important aspect. American stocks, the S&P gained 5.25%. That's a big week. And the Nasdaq rose by 6.8%. So they're huge weeks, as we'll see on the charts. The Russell also up 4.5%. The equal weight S&P was up nearly 4.5% as well. So this was a very, very large week. And all the losses since the Liberation Day announcement have now been erased. So the market has bounced back fully. So this is the epitome of a V-shaped recovery. The US dollar slightly higher again, back over 101. It's only a couple of weeks ago it was down at 98 and looking pretty shaky, but a little bit higher. The 10-year yield got up above 4.5, but did ease a little bit. And the VIX is now down to 17, which is getting back down into more normal territory. Let's go and look at some of the key charts. So this is the S&P on a daily, and you can see we started the week, that was last Friday before last, the 9th of May. So we started the week with a huge gap higher. And what huge gaps tell you is that the buyers have so overwhelmed the sellers, they're climbing over themselves to buy, that the market just gaps up. So that is a massively bullish sign, as it was from here to here, and then from here up to here. So huge signs of buying enthusiasm, and the balance between buyers and sellers has shifted very abruptly. So a huge V-shaped rebound, and now we've just gapped straight above the previous peak, which was a pretty important level through here. When it's all said and done, this was a pretty key level because it picked up so many turning points in the market. Little one here, another one here, and of course this last peak here from March. So this is an enormously positive chart now. So that's the S&P, the Nasdaq, something similar, with a huge gap up on Monday, and then you'll notice all green candles from there. So the close was higher than the open. Now there's a few little wicks on this, but you can only look at that chart pattern and conclude that it's very, very positive price action. Semiconductors, really important, and that's the semiconductor index on a weekly chart. So we're not that far back. We've managed to recover probably 80% of that decline. And now with these deals in the Middle East, with Saudi and UAE, it's extremely good for NVIDIA. And then, of course, that effect washes through the whole sector. So this is particularly good news. The US sectors, where's the money flowing to over the last month? Well, top of the tree now, we've got technology back up there. We've got consumer discretionary, followed by communication services, followed by banking. So this is the order you want to see in a very bullish market. Healthcare at the bottom, but look, some of that has been the plunge in the price of United Health, which is one of the world's biggest hospital operators, and they've got a series of woes, and that is dragging the health sector down. In Australia, information technology was top of the tree over pretty much the whole of the last month. Really strong recovery there. Energy is having a short-term run because of the higher oil price, and I suspect that sector had just got oversold anyway. And then we've got finance and materials and healthcare at the bottom. So that's where the money is flowing at the moment. It's definitely going into the more positive sectors of the market. Okay, so that's the US market. Turning now to the Aussie market. Our dollar finished 63.5. And it's coming just at a time when it looked as though the US dollar had broken key support and was heading down into the low 90s. It's now back at 101. And that, of course, has impacted the Australian dollar. The ASX 200 rose 1.4% for the week, and it's hard to know how we're going to open on Monday because the US close was positive. But then after hours, we had this bit of a spike down on the credit rating. So we might see a bit of a mixed picture on Monday. On Friday, our market was also a bit mixed in terms of how it closed, in terms of the supply and demand on individual stocks and sectors. The outstanding gainers in Australia, though, no matter what happens with the US credit rating and what impact it has on markets in general, the outstanding gainers have a common theme. There are common characteristics that set these stocks apart. And there's enough of them to absolutely fill your portfolio, and there's enough diversity there for those that feel that diversity is an important aspect. So they're the stocks that we focus on almost exclusively in the Insiders Club, and they're stocks that get discussed and analysed quite a lot in Portfolio Analyst. So that is where the good action is. So we'll go and take a look at the Australian indices. So that's where we finished on Friday, and you can see we were trading quite a bit higher, but then traded down at the end and gave back nearly half of the gains on Friday. So it would appear that there is certainly sellers ready to do their thing, and with the US credit rating downgrade right at the end of last week, they've probably got some more ammunition to work with. So I suspect we may see a bit of a weaker opening in the Australian market. Just while I'm here, let's look at the precious metals space. So this was silver. So silver has really just been going sideways for the last few weeks. Not much change. The gold price in US dollars on a daily chart. So it was generally down for the week. We had a couple of up days, but overall we're declining, and it's now back to the 50-day moving average. And you've got to say that this is more of a negative chart than a positive chart in the short term. You know, the bigger picture for gold still remains in a significant uptrend. You can even see that on the daily chart. The 200-day moving average is still up. The 50 is still up. The price is still above both of them. So this is still a big picture uptrend. But in the short term, we've got a lower high and a lower low, and we've got pretty negative sort of candle formation. But look, we're in such a uncertain world that a fear premium could come back into gold in an instant. So I think with gold, you need to be clear about what your purpose for owning it is. And I don't see that anything much has changed there. There's the Australian dollar gold price, which finished at just a tick over 5,000. And I will touch on Bitcoin as well. So Bitcoin managed to finish the week at $103,500. So that is still looking very positive. And if you just look at the chart, we've had a run back up, very strong run back up, and then sideways. We then had another surge on the 8th of May, and then again, just flat, no retracement. So it looks as though it's gathering momentum to have another crack at breaking out above just under 110,000. So that's one to watch. So precious metals, I think I've pretty much covered all that. It was down $123 to 3,202. It's really around this sudden wave of global cooperation that has put a bit of strength behind the US dollar and also reduced the fear premium as well. But from what I can see, and I've been talking in recent weeks about the main drivers of the gold price, I don't see that any of those main drivers have changed. Part of the fear premium coming out, we've seen now the potential, I don't know if they've actually got down to it yet, but the potential for US and Ukraine to be dealing directly in terms of some sort of peace negotiation. And also we've got a ceasefire with India and Pakistan. So both of those situations certainly help remove the fear premium, plus, of course, the de-escalation of tariffs. Stocks taking a bit of a breather in Australia. It was a tough week generally with gold down, but there were some solid finishes for some of the locals, and there's still a huge divergence in stock performance. It's quite surprising the difference. What makes the difference between the gold stocks that the market treats well and the gold stocks that the market just treats according to whether the gold price is up or down? And that's something that we've been looking at in Portfolio Analyst for several weeks. And we'll probably do a bit more of in this week coming as well. Now, Bitcoin, the whole crypto sector got a bit of a boost from news around Coinbase that's being elevated into the S&P 500 index. And Coinbase went up by more than 20% on that news. It's a meaningful step. The enthusiasm was because it's a meaningful step towards more institutional acceptance. And as month and month goes by, we're just seeing greater acceptance in all sorts of places for the whole cryptocurrency sector. So it's all quite positive. If we look at Bitcoin, there were inflows into ETFs, quite significant inflows, and also just a more risk-on kind of environmental sentiment with more likely Fed rate cuts. So that's the situation with respect to Bitcoin. Turning to other commodities, copper edged down just a little. Nickel was around $7, and crude oil holding around 62.5. Now, if we look at crude oil on the chart in just a minute, at a big picture, it's broken key support a couple of weeks ago, and it's in strong downtrend. So when you look at the chart, you can't conclude anything other than crude oil is in a significant and quite robust downtrend. There are short-term rallies, but that happens in anything. You get 3 or 4 steps to the downside and then 1 step back up as people try to pick short-term bottoms. But the overall trend, as you'll see, is quite clearly down. And this is the West Texas Intermediate crude chart over the last 5 years. We peaked out just under 120, dropped fairly sharply, but since 2023-24, you can see we've got lower highs and lower lows, no question about it. We got a break of very key support and dipped under 60. Now, it's possible, of course, that this could rebound on some better news. But the overall trend at this point in time, you can only call it as the data is presenting at the moment. And all we can see is a break of major support and lower highs and lower lows. It's in a downtrend. And there's no need to think too much more about it. Crude oil. Wrapping it up, final thoughts. Prospering in these uncertain times. This is a time of year when the sell in May and go away rhetoric starts to come out. Don't get drawn into that. It's just a bit of a sideshow. The overall stats don't actually really support it very much. And also, if you're looking at individual stocks, then individual stocks can and do their own thing anyway. So just focus on your plan, focus on the process, whatever process you use for selecting stocks. And the best stocks just keep rising regardless because they're being valued on their long-term earnings growth. So just do that and not much else. Portfolio Analyst this week, we're going to be comparing conventional thinking stocks that the masses say, oh yeah, you must own that because it's a household name, without really thinking too much about the merits. Comparing those sort of stocks with the real outperformers, the stocks that are justified to be rising very significantly, doubling their price in 12 months kind of performance. For those that are members of Portfolio Analyst, and there is a 2-week trial available there, I think you'll find that very interesting. And of course, that then leads into the stocks that can be outstanding performers, but still safe in inverted commas. And for me, some of the big household names are not safe. And over the years, that's been proven to be the case. A major top 100 stock that falls 60 or 70 or 80% is hardly safe. And yet we see that time and time again. So there are other alternatives. And just because a stock has a smaller market cap or a medium-sized market cap doesn't mean that it's not as safe as a big stock. In fact, in many occasions, they're actually safer. So we'll be looking at some of those as well. So that's it for this week. More information on the website. Here's the email address. And I'll be back with you next Sunday. Cheers.